As the next payslip comes closer, I've been looking at new growth stocks to add to my portfolio. These new stocks are currently trading at a good price and they also have a good chance of growing a lot over the next 3 years. If you're interested, smash that like button and let's get to it. First of all, we have Palantir, trading under PLTR. If you haven't heard of Palantir, well, they had their IPO in September 2020. Palantir are a controversial data company that provides a number of products like Foundry, Gotham, and Apollo, which they sell to government and enterprise clients. The actual details of what those products do are very complicated, but in simple terms, they provide data integration. These products help users deal with and process unstructured data, which is a really big problem in the IT space right now. In fact, roughly 80 to 90% of all data in the world is unstructured, and Palantir is one of the few companies that allows users to tap into that unstructured data. This is really what makes Palantir unique. There are not a lot of companies that do what Palantir does. In fact, there's probably less than 10. This is also why Palantir now has a huge following online. A lot of people love it, a lot of people hate it. But the good thing is that this means there is a lot of research materials online that you can look at. Palantir is still in the early stages of growth and is expected to grow in revenue by about 24% annually, while their earnings are expected to grow by 77% annually. Still, Palantir is currently unprofitable and they have lost $520 million in the last 12 months. They are currently not expected to make a profit until 2024, so at least 2 years from now. However, they have no debt and cash equivalents of about $2.52 billion, meaning that they can continue to run for at least 5 years before they run out of cash, so their financial situation is looking solid. The only problem that I personally see with Palantir is their massive operating expenses. Currently, they're incurring more operating expenses than the revenue that they are generating. They have $1.61 billion in operating expenses with only a $1.54 billion in revenue, which is really concerning. However, as I said, Palantir is in a very early stage of growth and I'm hoping that they will resolve this issue soon. In fact, the reason why they have such high operating expenses is Palantir's massive stock-based compensation. In 2020, Palantir had $1.27 billion worth of stock-based compensation on a revenue of $1.09 billion, while in 2021 the stock-based compensation was only $778 million on a revenue of $1.54 billion. I've mentioned this in other videos, but stock-based compensation is a slightly misleading metric. It is recorded as an expense on the income statement, but it's not really something that the company pays. This is why a lot of the new tech companies use adjusted EPS, which accounts for that. If we take away the stock-based compensation, Palantir is actually doing really well. Still, high stock-based compensation is not a good thing because it dilutes company ownership. But the main point here is that Palantir's actual income is much higher than the one we've seen. Their $520 million loss in 2021 is actually a $258 million net profit if we account for the stock-based compensation. Anyway, right now what's important for Palantir is to get more customers, more big contracts, and that's really what they have been focusing on. Last quarter, Palantir added 15 net new customers worth between $1 and $10 million and 19 net customers worth $10 million or above. Plus, Palantir is currently trading at its cheapest since the IPO. The average analyst price target is $16.28 on a current price of $10.48, which gives us about 53.4% upside. A simple discounted cash flow model also gives us a valuation of 15.33, which is an upside of 46.3%. Personally, I think we can see much higher prices for Palantir, but my main point here is that at a price of $10.5, Palantir is at one of its cheapest prices yet and can give you a decent profit. However, Palantir is still a relatively expensive stock. Its growth is priced fairly with a PEG ratio of 1.33, but its forward PE of 53.8 for 2022 is relatively high for the US market, just like with any other growth stock, so you should approach it with caution given the current situation with inflation and interest rate hikes. However, I think that it's worth looking into Palantir and putting it on your watch list. Then we have Sonos, trading under SONO. Sonos is a company that designs, develops and manufactures multi-room audio products around the world. Chances are you or somebody you know has Sonos products in their living room or bedroom. Sonos offers an array of high-quality audio products, and a quick search on Amazon will show you that they have thousands and thousands of 5-star reviews. 2021 was a good year for Sonos as they reported their best results yet. The company isn't massive with a market cap of $3.4 billion, $1.7 billion of revenue, and $149 million in earnings. But it is finally starting to see consistent growth in both revenue and earnings. Analysts are expecting 23.2% annual earnings growth and 11.3% annual revenue growth, both of which are above the industry average and the US average. The Sonos management actually expects a revenue growth of between 14 and 16% for 2022, along with earnings growth of only 14.9% to 16.2%, so hopefully they will give us some pleasant news. In terms of finances, Sonos has no debt and has a cash equivalence pile of $754 million, basically meaning that its enterprise value is only $2.7 billion. An enterprise value that is lower than the company's market cap is always a good thing. Also, given that Sonos has a PE of 22.9, which is slightly lower than its historical average, and also has a PEG ratio of 1, the company is looking really cheap right now. PEG ratios of 1 or less mean that the company is valued fairly for its expected growth, so it's good to see that with Sonos. Analysts are also revising their revenue expectation for Sonos in 2021, with 7 revisions up and 0 down, but it looks like they're mixed when it comes to earnings, with 2 revisions up and 2 revisions down. Still, the fact that they're unanimously raising revenue expectations is a good sign. Plus, Sonos seems like an all-round good business. Good value, good financials. The management also seems to be doing well in terms of effectiveness because Sonos has a 22% return on equity compared to the industry average of 19% and a return on assets of 10.9% compared to the industry average of 9.7%. That's really good to see because it means that Sonos is capable of putting their money to good use, which is what every investor wants to see. Return on equity and return on assets are 2 of Warren Buffett's favorite metrics, so it's good to see that Sonos is doing well there. Now, the only problem I can see with Sonos is optimistic analyst expectations. There is a chance that Sonos's growth will slow down because of supply chain issues. In fact, we have already seen that, although the impact wasn't actually that bad. Still, it could get worse. Plus, sales could slow down as people finally start spending more on holidays, vacations, and so on. Another potential problem for Sonos is the competition that they're facing from Amazon, Apple, and Google. The problem there is that its competitors have a lot more capital and a much bigger following, plus lower prices. Sonos does seem to offer the higher quality product, but will that be enough to attract customers, or will people prefer the cheaper option? We just need to wait and see. Apart from that, Sonos is looking like a really solid pick in my books, with strong fundamentals. The average target price is also relatively high, with an average estimate of $41.43 on the current price of $26.53, so that's a potentially big upside of 56.2%. My discounted cash flow valuation also gives Sonos a fair value of $87.87, which is really high and an upside of 231%. I'm not sure if we will see prices like that in the next year or two, but it does show that Sonos is likely to give us some good profits if we buy it at this point. Palantir and Sonos are 2 of the stocks that I'm currently looking into and researching. Obviously, don't just take my word for it. Do your research too, but please let me know what you think. Are you bullish or bearish on them? What stocks are you looking into right now? If this is your first time here, please leave a like, subscribe, and share if you like the video. Thanks for watching, and I'll see you again soon.